have joining now one of the most definitive voices on emerging markets, a 40-year veteran of EM investment cycles, Mark Mobius, founder of Mobius Capital Partners. Good morning, Mark. Thank you so much for joining us. Well, the emerging market currencies have seen some kind of stability in the last 2 or 3 trading days. Would you say the worst is over for this pack?
Yes, I believe a lot is behind us because, as you know, these currencies have been falling dramatically, far beyond what you would expect. So, yes, I would say many of these countries have now begun to stabilize. You might see another 5 or 10% decline, but I think we're pretty much near the bottom.
Mark, good morning. The big worry is the higher yields in the US, and now that the Fed will continue to raise rates. Do you think that will hurt the EMs?
Well, there's no question. The higher interest rates in the U.S., the Fed rising rates, is having a tremendous impact. But you must remember, a lot of this has been already anticipated by the markets around the world. We all knew, in fact, earlier this year, I figured that the Fed would rise interest rates by at least 5 or 6 times in 1 year. And already we've seen a number of increases by the Fed. So this has been pretty much taken in the market, and the reason why these currencies have weakened so much.
Mark, hi, morning. So do you think there could be a further destruction of currencies and equities from emerging markets particularly?
No, I think there could be continued departure from emerging markets for a while now until these currencies really stabilize. You must remember, usually what happens is that currencies go down, the markets go down, then people say, oh God, I'm losing all this money, let me get out. And this takes time. You know, they continue to exit. Then after a few months, they say, oh, maybe there's an opportunity, then they come back in. So I don't think we can count on a huge flow in or out. There's going to be a little bit more out, but then eventually it'll come back in.
Okay, we are waiting for that eventual date. Well, let's focus on India now, Mark. We saw a vicious liquidity crunch lately in the debt markets. Would you think that non-bank finance companies are a worry?
Of course, we would worry about that, and we know that the bad loans are very numerous in these banks, and probably the numbers that we're seeing are not exactly accurate. They're probably worse than it looks. But given that situation, there are probably some good opportunities in some of these non-bank finance companies, for example, and other areas in the financial sector in India. So we're looking at that very carefully, particularly because of this prevalence of bad news in the sector.
Okay, so would you worry about any domino impact from any of these companies defaulting?
Well, already, as you know, we've had this infrastructure situation where the government had to step in and bail the company out. So that itself could have been very destabilizing if the government had not acted. So I think that's the biggest one. I don't think you're going to see anything bigger than that now, and things have probably stabilized. But I think it's very important for the Indian government to make it easier for investors to put money into the market from overseas. In our case, for example, we want to invest in India, but we're going to have to wait 3 to 4 to 5 months before we get permission to put money into the market. So I think it's very important for the Modi government to move on this to make things easier for investors.
Would you worry about consumption dropping off if NBFCs don't lend much for some time now? Because that's the big concern on the street as well.
I think you're absolutely right. Many of the non-banking institutions were a little bit too aggressive, and they're now sitting on incredible bad loans. So the degree to which they will pull back in order to get some liquidity, then the consumption will decline. But if you look at the overall picture in India, the number of people that are borrowing in order to spend is probably much, much less than you'll find in other parts of the world, at least in the developed countries like the US. So I don't think it's going to be a major, major problem. The big problems will come from the large institutions, the large borrowers who are in trouble and who represent a lot of the bad loans in the banks.
Okay. Well, Mark, I hope the capital markets regulator is listening and your registration doesn't take time. But if you can buy, what sectors will attract you in India? If it's not the non-banks, is it the banks?
Not yet. We're not focusing on the banks so much. We believe that probably there's going to be more to be done in order to reform the banking sector and wipe out the bad loans and deal with that. We are particularly interested in the consumer sector. We believe that the consumer sector in India is going through incredible changes, particularly because of what's happening on the internet. So this combination of traditional retailing, for example, and internet buying is going to create some exciting opportunities.
Okay, then, so would you buy now or will you wait for currencies and equities to get a bit more cheaper?
We would buy now because there are a number of stocks that we have on the list which we think are very attractive. So we have specific opportunities in India that we like.
Okay, that's good to know that you will be looking to buy now post the fall. Do you think equities and currencies will fall some more through the course of the year?
I think the currency could get a little cheaper. Of course, it's come down a lot, but I think it could get a little cheaper. A lot depends on the degree to which the government can open up the market and bring in more foreign exchange. I think that's going to be very important. But I think we're near the bottom. As you know, in most of these emerging markets, the currencies have come down so much. We've reached near the bottom of the range.
Well, Mark, is politics a worry for you? I mean, possible political changes when the big elections happen next March, April?
Of course, if there's a political change, there'll be some uncertainty. However, a lot will depend on how investors look at the government and the degree to which they believe the government will increase the reform movement. We've been a little disappointed with the current government in opening the market, as we've experienced that I just mentioned. So perhaps a new government can do a better job in opening up the market and introducing more reforms.
All right. Well, what about oil prices? I mean, we've seen a bit of stabilizing as far as oil is concerned, but do you believe oil prices can rise more from here?
Yes, I believe oil will move up to 100 by the end of the year or sometime next year. So we got to be ready for that. Of course, the dollar has gotten stronger against so many currencies. So in local currency terms, it becomes more expensive. So a lot of the efforts to reduce consumption of fuels, of gasoline, of oil fuels, and increase other fuels is going to be very important going forward. But as I said, the key for India, I think, is to encourage more foreign investment to come into the country.
Okay, India's current account deficit was a worry. Has that been allayed by the depreciation?
Of course, it's a big worry. You know, the deficit is something that foreign investors look at very, very carefully to ascertain whether, you know, the currency will get weaker, and more importantly, there'll be currency controls, because that would be putting a big damper on foreign investment. In this respect, I believe India could benefit from the trade war between China and India, China and the U.S. rather, because China will not be able to export a number of things to the U.S., and perhaps India will be able to replace China in that regard. So this is something the Indian government should look at very carefully. And of course, in that context, again, I have to emphasize they have to reduce the regulatory framework and make it much easier for investors to come in, establish factories, and export. It's going to be the lifeblood of the country going forward.
Yes, yes, you've been saying that. And we prided on ease of doing business. So, yes, a lot of work left to be done. Okay, what about the Reserve Bank's latest policy? They didn't hike rates. Did that worry you?
It does worry me. There's no question about that. And in fact, in the past, I've recommended that they not move on interest rates. In fact, lower interest rates. I know the prevailing wisdom in central banks is that in order to reduce inflation, you got to raise interest rates. I don't entirely agree with that in every case. And I think that's something that the central bank of all these countries should look at carefully.
No, actually, among foreigners, there was a worry that RBI didn't hike rates enough to shore up the rupee.
Now, I believe that currency is all about confidence. It's not so much about interest rates. For example, you look at the euro now. The euro, if you put money into a European bank in euro, you'll get point something percent. You get far less than even 1%. In some cases, you'll get nothing. And in fact, earlier this year, you were actually paying the bank to keep the money. Now, why is that? Because people are confident of the euro. So I believe the interest rate is just one factor, and sometimes it's pretty irrelevant.
So, what's your pecking order in emerging markets right now, Mark?
Well, believe it or not, India is right at the top of the list, despite the fact that we can't invest right now. Brazil is up there. We're very interested in what's happening in Turkey now. That may be an opportunity going forward. So there are a tremendous number of opportunities open for us.
Okay, that's good to hear. Developed markets also rocked. Will they stabilize anytime soon, you think? I mean, the last few days have been a bit of a turmoil for them.
I believe that the U.S. market has been in a bull run for a long, long time, and a correction is long overdue. So earlier this year, I expected the U.S. market would probably correct or come down or maybe even enter a little bear market. And if you look at the top index stocks in America, you'll see these are internet stocks, dependent upon big flows of money to acquire other companies that often are not making any money. And with higher interest rates, people are beginning to look at earnings of these companies and say, look, I'm not going to put money into a company that's not earning anything. So interest rates definitely have had a big impact.
Oh, yes, they have. But anyway, we saw some stability on Friday. Well, finally, Mark, since you've observed this world over 4 decades, will this tariff war slow down the emerging markets in particular and global economy in general?
There'll be a slight slowdown, but not so much because of the trade war, but because in the case of China, the Chinese market has gotten so big, you cannot expect 9–10% growth. We'd be happy to see 5 or 6% growth in China. And of course, looking at the total global situation, the China weight is very high. So if you take just an average, a mean, of all the growth rates around the world, I don't think you're going to see much of a decline. I think you're going to see some good growth. Because there's some countries that are now undergoing incredible reforms, such as Brazil, Argentina, and we expect these countries to come back up and start growing again.
Okay, Mark, always a pleasure speaking with you. Thanks so much for joining us. That's Mark Mobius talking about how he's bullish on the Indian markets. He would look to buy now. But still, he was waiting to see whether the currency stabilizes. Until then,
I think his big grouse was clearly that he's not been allowed to buy.
Yeah.
He thinks the registration process is taking too long.
Okay, well, that's a big hindrance for him. But overall, he's quite bullish on the way the Indian markets have panned out. And he thinks this is a good time, at least for other investors, to buy into this space.